of these returns are done, and what happen if IRS found something missing or some error in your return, then what it will be the appeal process and all. So first is overview of IRS audit process. So IRS audit process basically is the audit of your tax returns, whether you have filed your tax return accurately and ensure compliance or not. Auditor may result in no change. So when they audit your federal income taxes return, then they may find some problem in your return, or there may be no problem. Everything will be accurate. It means audit can result in either no change, or there may be some additional tax which is due, or there may be refund of taxes. Okay. So types of IRS audit. So first is correspondence audit. Correspondent audit means which is done by mail. IRS requests documentation for specific items. Okay. So for specific item, they may ask you their spotting documents like IRS notice mismatch on form 1099 INT. That means this form is basically filed for to show our interest income. So if you have shown your interest income in your schedule B in form 1040, they may ask you to give you certain more details, like they may ask you to give your form 1099 INT, or they may found something mismatch. So they may ask you some documentation which is called the correspondence audit. Next is office audit. So office audit is basically conducted by IRS revenue agent either in the IRS office or by correspondence. So these are conducted at the local IRS office. For example, Schedule C expenses may appear unusually high in your tax return. So this is called the office audit. So these are generally used for individual return for a few or no items of business income. Okay. Next is field audit. Field audit is basically when a IRS representative visit to a taxpayer place of business and do some audit. This is called the field audit. This is the most comprehensive audit, and IRS visit the taxpayer business place. Okay. For example, uh, they may visit your business place to review the inventory, to review payroll and revenue records. So these are some of the audit which are done by IRS. So how returns are selected? So basically, almost all people or a lot of people file their returns. So how is the returns are selected? Basically to uh, test. So basically, DIF scoring system identify return with high audit potential. So basically, what happens? They may do some mathematical algorithm and all things to identify some of the returns which have high audit potential. They may document matching using form W21099, some related party audit, some random selection. So this is how the some of the returns are selected to do the audit. Statute of limitations means when you file your tax return and how much time is there that IRS comes to you and ask you for certain penalty, certain errors in your tax return. So if generally it is the up to 3 years that IRS come and ask you if you have any errors in your tax return. If your error or a income omission is greater than 25%, then the time period will be 6 years. Means up to 6 years they can up to 6 years they can come and ask you if there is any error and something omitted in your return. Or if you have shown something fraud in your tax return, then anytime IRS comes to you and asks you for fraud related things. So this is the unlimited time period. Next is audit procedure. So how is the audit procedure basically done? So first of all, IRS send an initial letter requesting meeting or documents. They may ask, they may issue the information document request. Then they may interview the taxpayer or the representative. Then is the examination of book and record. And officer issues finding on the form 4549. So this is the process. How is the audit done? So what are the various rights of a taxpayer in case of if you IRS comes to audit your return? Then you may have the right to representation, like if IRS comes to you and ask you like to do certain changes, or they may ask you that you have something error in your tax return, then as a taxpayer you have the right to represent yourself in the court. You have the right to appeal. You have the right to privacy and confidentiality. You have the right to challenge the IRS position. Okay. So next is appeal and disagreement. Appeal and disagreement means like if an IRS send you a notice regarding certain changes in your tax return, then taxpayer may request a meeting with IRS supervisor. Like if you want to discuss something, then you can have some meeting with the IRS supervisor. File a written protest to IRS appeal. Like if you are not agree uh, with the changes and you are not ready to the changes that is suggested by the IRS, that you may file a written protest to IRS appeals. You receive a 90 days statutory notice, which is the notice of deficiency. So we will discuss when it is issued. Closing agreements means you have certain form 870, which is waiver of restriction, form 906, final binding agreement. So this will come in the later slides, like when there is issue. Okay, some practical examples are given, like if something found in your tax return, like you claim $40,000 of expenses in your Schedule C. But when they ask you for some receipt, then you have only 25,000 of valid receipts are there. Then 15,000 is the additional expenses you have claim in your tax return, but you do not have any proof. Then the IRS may ask you to have the adjustment for $15,000. These expenses should be added back to the taxable income, and you have to pay the taxes on these income. And in case if you are agree with their adjustment, you can do. But if you are not agree with their adjustment, like if according to you this is the right adjustment you have done, then you may appeal to the IRS. Like you can file for the you can file for to uh, you can return protest to the IRS appeal. Okay. So taxpayer appeals and provides supplier affidavits. Final agreed expense allowed is $33,000. Suppose you have appealed and final conclusion reached that you can deduct only $33,000 of expenses. So this is the example given, like how is basically the process is done. Any doubt till here?
No, ma'am. No.
Okay, so next is the appeal process. So how is this whole process is carried out? So first is purpose of IRS appeal. So IRS appeals means like if IRS comes to you and ask you for certain adjustment, then in that case, if you are filing for IRS appeal, then what is their purpose and how is it done? So independent review function within the IRS is to resolve tax dispute without litigation. It promotes the efficiency and taxpayer rights. Appeal officers are not involved in the IRS examination. So the officer who have done the IRS examination basically not involved in the IRS appeal. So it is done by other officers. So when a case can be applied? So when you applied for IRS appeal, so after receiving a notice of deficiency, it is a 90-day letter which is issued by IRS. So only after issuing this notice, you can file for the appeal. Or after receiving an examination report with dispute items for certain penalties, must have a genuine dispute, like frivolous positions are rejected. So, but for any dispute you are filing for IRS appeal, then you have that dispute should be genuine, like not for any dispute you can file for IRS appeal. Okay, so giving you the some summary, like how is the basic process is done. So first of all, then your tax return is audited by the IRS, and they may ask you to do certain changes, or everything will be okay. So if they ask you for certain changes, then it is up to you that you are ready for the changes or you are not ready for the changes. Okay. So if the agreement is reached, a taxpayer can file for Form 870. Okay, so if agreement is not reached or if the examination was conducted in the field, the IRS will send a taxpayer copy of examination report and a preliminary notice 30-day letter. So first of all is 30-day letter is issued. Okay, after issuance of the 30-day letter, the taxpayer basically has the 30 days to accept the deficiency, or they may request for IRS appeal. Okay, so if you're not applying for IRS appeal, then they may issue a 90-day deficiency letter. So basically this 90-day deficiency letter is issued by IRS in case if you are not filing for any appeal. That means taxpayer has overall 90 days to file a petition for the tax legislation, litigation basically. So if within these 90 days, if you are not begin your tax litigation, then that means IRS has the right to comes to you and ask you for whatever the additional tax liability which is claimed by the IRS. Okay, so if you are not applying for tax litigation, or if you have not started tax litigation within 90 days, then IRS comes to you and within 10 days they may ask you to pay the additional amount. So what happens? So first of all is 30-day letter is issued. 30-day letter is issued when when IRS comes to you and asks you for certain changes. So if you are applying for the, if you are ready to do changes, that is okay. But if you are not ready to do changes and there is no agreement that is reached, then they may issue a 30-day letter to you. So issued after if taxpayer disagree with changes and give 30 days to request for the appeal review. That means you have 30 days. Within these 30 days, you can apply for appeal. Filing an appeal. So protest letter basically. It is required if taxes are greater than $25,000, and it must include taxpayer information, what is the statement of fact, issues in dispute, and law or authority supporting taxpayer's position, signatures under penalties of perjury. Small case request means like if your tax liability is less than $25,000, then it is a small case and it has simplified processes, like no formal protest is required. So within 30 days, if you are filing for appeal, that is okay. Appeal conference informal meeting. So appeal means basically you are conducting an informal meeting, can be in person, phone, or correspondence. Appeal officers focuses on hazards of litigation, and taxpayer may be represented by CA, attorney, and EA. Appeal officer authority. So basically, the when you are applying for appeal, the appeal officer authority is to, they can settle the case based on risk analysis, cannot reopen issue not previously raised, cannot negotiate if taxpayer will not compromise. Okay, so in case if you are not applying for appeal in within 30 days, then the IRS will issue a notice of deficiency to you. A 90-day letter is basically issued. That means you have 90 days that you can start a tax litigation. Okay, so taxpayer has 90 days to file a tax court petition, and taxpayer goes to tax court, appeal, maybe still attempt settlement. Or if you are not, you are failed to go for tax court petition, then the IRS has 10 days, like within 10 days, they can claim the payment additional tax liability from you. Now, any doubt till here?
No, ma'am.
Yeah.
Okay, so next is the appeal to US tax court. So when you are appealing to the US tax court, they may ask for no payment before filing court. Basically, US, there are different levels of court. So first is US tax court. So they basically do not ask for you payment before the filing. Prepayment forum, tax court conduct new review not bounded by the appeal. So what happens in the tax court? Basically, they only conduct federal tax cases. First is this. Second, they will not ask you for any payment that is required to the petition. Like, you may do not have to pay anything to the court before taxpayer goes to the court. You have some trials also. So this is happens in US tax court. Fast track settlement means you can have certain cases which you can have their settlement within short period of time. These are only available for certain cases. Mediation like processes with appeal involvement, and these usually resolve within the 60 days. So basically, small tax cases are those cases like in which the amount is less than the $50,000. So amount should be $50,000 or less. Then you may go for fast track settlement. Okay. So when a taxpayer goes to court, so as I told you, when they file for petition, when the IRS issued a notice of deficiency, a 90-day letter is issued by IRS. So within these 90 days, you can go to court and file a tax petition. Or paying the taxes, filing for refund, or IRS denies or fail to act, then in that case you may visit you may go to court and file for petition. Federal courts basically. So in the US, you have US tax court, US district court, US court of federal claims, and apart from this court, you also have US Supreme Court and US Court of Appeals. So what happens in US tax court? Basically, these conduct specialized. These are specialized tax court, which only include the federal tax cases. Like if you have any case related to federal taxes, only then you can go for US tax court. They may not ask you for any payment before filing. There is no jury trials available. Types of opinion, they can have regular, memorandum, or summary. Basic advantage is that all the judges are tax expert judges, and there is no tax prepayment. Disadvantage is you can't go for jury trial here, and IRS satisfactory wins more. So for example, if a taxpayer dispute have 35,000 of deficiency and cannot pay first, to the tax court, US tax court. Okay, so next level of court is US District Court. So US District Court, they can hear the cases related to state or district. Here, jury trials are available, means uh, a group of people can discuss the matter and decide for what will be the outcome of that case. Here, you have to pay first and then request for refund. This is a general federal court. Advantages are that you can have jury trial option here. This, you can take your cases related to your state and local taxes. Disadvantage is that you have to prepay the amount and then you may ask for the refund. And here the judges are uh, not very expert, so they may lack tax expertise also. Okay. So example is business owner pays $100,000 dispute and seek jury. They may go for district court. So next is US Court of Federal Claims. So US Court of Federal Claims, it basically include all the matters which are national tax matters basically. Here also you have to pay first, then you may ask for refund. No jury trials are available here also. Here you can go for the cases related to your money damage against the US, one type of which is like your tax refund cases. Handle large and complex cases basically. For example, you have some 4 million adjustment dispute, then you may go for Court of Federal Claims. Any doubt?
No, ma'am.
Okay. So next is the appeal process. So how you can go for appeal. So basically decision can be appealed. Tax court is usually appealed to the Court of Appeals, taxpayer circuit. District court also like comes under Court of Appeal. Federal claims, Court of Appeal for the federal circuit. So final option is your US Supreme Court. US Supreme Court is the highest court in the nation and is the last level of appeal here. So any cases which are not basically resolved in these courts, so they may go for US Supreme Court, but uh, rare, only rare cases will be here in the US Supreme Court. So normally here cases only if they involve a conflict of interest basically between different court of appeal. So if you have conflict of your cases, then you may go for US Supreme Court, and like not all the cases can you can take to the Supreme Court, only rare cases which are actually like complex or involve any conflict. Okay, so next is burden of proof. Like when you file a tax petition, like you have to prove something. So, like on which basically has the burden of proof there. So taxpayer generally has the burden, means they have to prove uh, what they ask, what they are claiming, what they are not agreeing with something. So they have the burden that they have to prove that they are right or not. So IRS burden apply well only. So it is the duty of IRS only when it is related to the fraud, civil penalties, arbitrary income reconstruction. Burden may be shift if taxpayer have keep proper record, cooperate fully, and provide credible evidences. Next is types of dispute. So you have legal issues, which is decided by your judge. You have factual issues like jury available only in district court. So you may have legal issues like something related to compliance part. Factual means something related to monetary amount. So if we summarize these types of court, so we've already discussed that in US tax court you do not need any prepayment, no jury trial are available, and you have all the specialized judges which may do a decision. But if you compare it with district court and court of federal claims, here you have to prepay the amount. At the district court, you also have jury trials available, and there are general judges which are not very expert. Under federal claims, you have to prepay the amount, but there is no jury trials are available. They usually handles the cases which are actually complex and large, basically corporate cases. Okay. So, for example, if you want to fight without paying, you may go for US tax court. If you want jury trial, you may go for district court. If you have something complex issue like large corporate issue, then you may go for court of federal claim. If you miss 90-day deadline, but you have to pay and sue for the refund. Any doubt? Any doubt till here?
No, very much.
Okay, so next are our taxpayers penalties. So in case if you are failed to file a tax return, or if you are failed to pay the taxes, then you may subject to certain penalties, which is imposed by the IRS. So you have first is failure to file penalty. Failure to file penalty means you have to file your tax return by some due dates. Like for individual, you have to file by April 15th. But if you are failed to file the tax return, then you have to pay certain penalty. This penalty is up to 5% of the unpaid taxes per month, or it goes up to 25%. Maximum penalty if more than 60 days late, the lesser of 485 or 100% of the unpaid taxes. So if uh, if the you are failed to file the tax return more than 60 days, then you have to pay this amount of penalty, which is lower of your $485 or 100% of your unpaid taxes. But if you fail to pay the failure to pay the taxes, since IRS said that whatever you are earning, you have to pay the taxes. So these taxes should be paid in some installment, like not completely at the year end. You have to pay certain taxes at the your estimated taxes with some installment and which have some due dates. But if you fail to pay the estimated amount to the IRS or required amount to the IRS, then you may have failure to pay penalty, which is 0.5% per month of the unpaid taxes, and it may goes up to 25% also. In case you fail to file a tax return as well as you do not have pay any taxes, so that means if both penalties will apply, then in that case your failure to file penalty will be decreased by 0.5%, means it goes from 5% to 4.5%. Okay. For example, you have certain unpaid taxes of $6,000 and you paid 5 months late. So if failure to pay penalty will apply, that means it will be 0.5% of the amount you have unpaid. Okay, so it is $150 per month. Since you are paying 5 months late, then you have to pay. You have to give the $150 of penalty to the IRS. Any doubt?
No, ma'am.
Okay. So next is accuracy related penalty. For example, if you have certain inaccurate text return, then you may subject to certain accuracy related penalty, which is 20% of penalty, which is applied to negligence or disregard of rule, substantial understatement of income taxes, substantial valuation misstatement. So the up to 20% of these you have penalty for the accuracy related penalty, like if you have do certain wrong in your tax return. Substantial understatement. So in case if you have substantial understatement, like there is more understatement, in that case the penalty will be greater of 10% of your taxes required to be shown, like how much taxes you have hidden, or $5,000, or it is up to $10,000 for the corporation. So whichever is the greater amount, you have to pay that amount to the IRS. Next is fraud related penalty. Like if you have certain fraud in your tax return, then in that case your fraud related penalty will be applied. It is 75% of underpayment attributable to the fraud. So whatever the payment that is subjected to the fraud, and you have not paid that amount, so 70%, 5% of that amount will be charged as penalty, which is called civil fraud penalty. Fraud must involve intentional wrongdoing. So basically, what is the fraud? It is the intentional act of doing something wrong. So if you have certain error kind of thing, like you have certain inaccuracy, then it is 20%. But if you have fraud, it is 75%. For example, you have certain underpayment due to fraud, which is $30,000. You have paid less to the IRS and then $30,000 of fraud, then you may subject to a penalty of $22,500. Okay. Estimated tax penalty means it is the penalty like which apply when you underpay the estimated taxes. So as you know, for a individual taxpayer, you have to pay sufficient taxes to the IRS in 4 installment. And to avoid this underpayment penalty, your estimated taxes should be 90% of current year tax, or it is 100% of prior year tax. But in case if your AGI, adjusted gross income, is greater than $150,000, then this uh, limit will be 110%. So whichever is the lower amount, you have to pay to the IRS in the form of estimated taxes. But if you fail to pay these estimated taxes, then your underpayment penalty will be applied. Okay. If we talk about corporation, since it was for individual, but if we talk about corporation, you have to pay your estimated taxes, which should be 100% of current year tax. Okay. No prior year safe harbor except for the small corporation. So for large corporation, that means whose annual gross receipts are greater than 1 million, then they have to pay the estimated taxes quarterly, which should be 100% of the current year taxes. Okay. Any doubt?
No, ma'am.
Okay. So next is dishonored check penalty. So this is the penalty for dishonored check. So it is 2% penalty if check is greater than of amount $1,250, or $25 is the penalty if the amount is less than $1,250. Next is frivolous tax return penalty. Like if you have something frivolous position in your tax return, then you have to subject to a penalty of $5,000. Next is failure to provide information penalties. Like if you fail to provide the correct information in your return, then you have to subject to a penalty which is range from $60 to $310 per form depending upon the lateness. Like if you have failed to provide W2 form or fail to provide 1099 form, then this penalty will be applied. Next, trust fund recovery penalty. So it is applied to the responsible person who willfully fail to remit the payroll taxes. So it is 100% of unpaid tax fund, uh, unpaid trust fund taxes. Next is substantiation and disclosure of the tax position. So substantiation requirement means taxpayer must maintain sufficient record to establish the amount of any deduction, credit, or other tax position. So as a taxpayer, it is your duty that you have to maintain your records which you are using to take any deduction, any credit in your tax return. And record must be accurate, complete, and contemporaneous. Applies to all tax position, include income, expenses, basis, credit, losses, whichever you are claiming in your tax return. So this is the duty of a taxpayer that they should have this record available with them. For example, if you want to claim a charitable contribution deduction in your tax return, then if the donation is more than your $250, then you are required to have some written receipt to claim for this deduction. Okay. Disclosure of tax position, like if you are taking any tax position, then disclosure is required when a tax position does not meet the substantial authority standard. Okay. So we already discussed about substantial authority, reasonable basis. Substantial authority means like if it is spotted by the IRS and there are chances up to 40 to 50%. Disclosure is usually made on the form 8275 or 8275R. Proper disclosures reduce penalties for understatement. So if we talk about these standards, so basically we discussed yesterday also, this has reasonable basis, substantial authority, more likely than not standard. Reasonable basis means which is 20% chances of success. Like if you are taking any tax position in your tax return, then if it has 20% of chances that it will be succeed, like it will be spotted by the IRS, then this is called the reasonable basis. Or if the likelihood is more than 40%, like up to 40 to 50%, then it is called the substantial authority. More likely than not means if there are more than 50% chances that of success. Reasonable cause and good faith means uh, like if a taxpayer is claiming that they have taken the position on a reasonable cause and some good faith, like they have not taken they have not taken to do certain fraud, to evade taxes, so they can claim waive penalties if the taxpayer relied on a qualified professional. Next is penalties related to substantiation and disclosure. So we already discussed like if you have reasonable basis, you have substantial authority, then in that case to avoid the penalties you have to undisclosed. Uh, but if there is more likely than not standard, the disclosure is required. Negligence penalty. So it is 20% of underpayment when the taxpayer lacks reasonable basis. So if you do not have reasonable basis for any tax position, then you have to pay the negligence penalty. Substantial understatement penalty will be applied if 20% unless adequate disclosure you have made. Fraud penalty will be applied, it is 75% of underpayment. For example, a taxpayer claims a home office deduction but keeps no record of square footage or exclusive use. So IRA disallowed deduction and imposes a negligence penalty on the taxpayer. So since they do not have any accurate record of the deductions they have taken, then IRS comes to you and asks you for certain penalty. For example, taxpayer relies on CPA written advice for complex transactions. So even if IRS disagrees, the penalty may be waived due to reasonable cause and good faith. So for example, if taxpayer has taken certain position on advice or getting an advice from a CPA, and since the position is not spotted by the IRS, then they may ask you for certain penalties. But if you have shown them that they have taken this in a reasonable cause and good faith, then the penalty may be waived out. Next is substantial authority. Substantial authority, as I told you, that if you have more than 40 to 50% chances, like more than 40 and up to 50% chances that the position will be spotted by the IRS without requiring the disclosures, basically. More likely than not, which have more than 50% of chances. Any doubt?
No, ma'am.
Next is acceptable authority sources. So if you have taken certain like deduction, certain position in your return, and this should have like some reasonable basis, some existence there. So what are the acceptable sources, like where you get the uh, where like this position is spotted? First is IRC, Internal Revenue Code. So these standards fix treasury regulations, court cases, revenue rulings and procedures, tax treaties, congressional report, technical advice memorandum. So these are some of the acceptable authority sources. Like if you have taken that information from these sources, then it is acceptable by the IRS. But if you have taken certain position by just reading the text article, media publications, and IRS informal comment, then this will be a non-acceptable sources. Next is when substantial authority avoid penalties. As I told you that if the tax position has substantial authority, like more than 40 to 50% chances, then they need not to disclose the position to avoid the 20% accuracy related penalty. So if they want to avoid the penalty, then they do not have to disclose that position in the tax return. So next is the foreign bank account reporting requirement. So this is required when a US person has a financial interest or a signature authority over the foreign financial account. So like if you have certain amount in your foreign account which is exceeding $10,000, then you have to file this form. It must be electronically filed with fines and not IRS. So due date is April 15, and you also get the 6 month extension here. Okay, for example, a John holds $6,000 in Singapore account and 5,000 in Swiss account. So that means if you are a US citizen and you have certain amount in your foreign account which is exceeding the $10,000, then you have to file this form also. Okay, which is FBAR financial foreign bank account reporting. Okay, it is required under IRC, Internal Revenue Code. Basically, applies to US individual if they have certain financial amount in the foreign accounts. Threshold is vary based on the filing status and residency. It is filed with annual income tax return. So if we compare, this is the FATCA reporting and under Form 8938. Any doubt?
No, ma'am.
So if we compare both these foreign bank account reporting and Form 8938, which is FATCA reporting, means your foreign account tax compliance act reporting. So FBAR basically filed with FinCEN. Form 8938 is filed with the IRS. Here the limit was $10,000 and here it depends upon your filing status. So 8938 form include more asset types. So mainly this is important that you should know that if you have amount in your foreign bank account which is exceeding $10,000, then you have to file this form. Next is penalty for non-compliance. So if you are non-complied with any laws and regulations, so here FBAR penalty is for non-willful, like if you do not have done intentionally, then it is up to $10,000 per violation. But if you have done intentionally, then it is greater of $100,000 or 50% of your account balance. Okay, if we talk about Form 893A penalties, then it is $10,000 if you failure to file the penalty, and additional $50,000 penalty is there for continued failure, like you're continuing doing this thing, like do not filing this form. Next is one more example. Mary, a US citizen, she has 8,000 in UK bank account and 4,000 in Germany brokerage account. So if we compare, we add these amount, then she have $12,000 in the foreign accounts. That means they have to file the form FBAR. Okay, if total foreign asset value exceeds 60,000 is $60,000 at the year end, that means they also have to file this 8938 form. Is it clear?
Yes, ma'am.
Okay, so this topic I will start from tomorrow because it is a big topic. So here we will discuss about various legal liabilities, like if you have certain breach of contract, if you have done negligence, gross negligence, fraud. So how which like persons has the power to sue to the person, which may be the which may be the penalties, which may be the liabilities. So we will discuss these things in next class. So if you have any doubt up to this topic, you can ask. Otherwise, this topic I will start from tomorrow.
ओके सकाळी जरा इंटरेस्ट
Do you have any doubt?
No, ma'am.
नो करेन
Okay, then we will start the next topic tomorrow. Thank you for joining. Bye.
Thank you, ma'am. Bye, ma'am.
Bye,
Bye.
ma'am.